What you need to know about your credit score and how it can affect you. Hi, my name is Serge with FindMyHouse.ca and EXP Realty, and today we're joined by the lovely Chita from the TMG, the mortgage group, and she's going to help us figure all this out. Hi, Chita.
Hi, Serge.
Great. Chita, so tell us, what exactly is credit, the credit reports, and why is it crucial to getting a mortgage approval?
Okay, so credit, the actual
Mm-hmm.
word itself, is just borrowed money. So rather than you using your own funds to finance, right? You're
Mm-hmm.
having to, borrow funds, whether it's from, a line of credit, a mortgage is credit, credit cards credit. When you go and get a loan for a vehicle, you're borrowing that money, that's credit. So anything borrowed is what we call credit. So,
Mm-hmm.
and why is it crucial? Well,
Maybe talk about the credit report first, and then why it's crucial.
yes. So in Canada, we have two reporting agencies, Equifax and TransUnion.
Mhm.
We brokers typically will, most often will pull the Equifax, and the TransUnion is a secondary, right? So, but we rely more heavily on Equifax. And so these reporting agencies basically take a collection of all the past histories of repayment of this borrowed money credit. So whether it's a mortgage, a line of credit, installment car loans, credit cards. So the history collects onto this report,
Mhm.
right? And the report spits out the history plus a credit score or a FICO score as well. So, and this report is a very crucial part of a lender's, I guess, like they use it to make a decision on your credit risk to see if you are, you're worthy of being able to have a, get approved for a mortgage. So to extend you more credit, right? So your past history of how how you've handled credit by repayment will give you the ability to show your worthiness of getting more credit. And typically, in my case, as a mortgage broker, I'm working on a mortgage file to get credit to get a mortgage to buy a house.
Right. So obviously, on a credit bureau, you said we would see what active or inactive credit lines might be there, right?
There's history. Yeah,
There's history. Yeah.
there's
Perfect.
history.
Right. And that could also include late payments, slow payments, and collection items.
Oh, yes. So the repayment history, the details that the report shows is pretty, I guess, thorough. Like so, from the date the credit is open, what the limit is, what the balance is at
Mhm.
the time of report, because it reports once a month. It shows me if there's any slow or late payments and when it happened, right? 30, 60, 90 days.
Mhm.
Yeah, it's pretty, it's very comprehensive when we brokers or, that report itself, it's absolutely very comprehensive. So, and it reports on current active and as well as anything you've closed. So it's within like the, say the recent 7 years, it still reports on the bureau, but it shows me when it was closed,
Mhm.
right? And so, and the history that you had on that card, right, before it was closed. So
Yep.
again, it's also lenders look at that because that's a part of the history that's indicative of your repayment habits.
So that would be something a little slightly different than the 7 year is, right?
Oh, Jesus.
Okay. All right. So now tell me a little bit about your credit score and those credit score ranges and how it could impact your ability on a mortgage.
Yeah, so credit score or FICO score, you can call it. So it's a number, right?
Mhm.
Let's say it's a grade, just like when you go to school and you have a math test, it's your grade. It's that score that we lenders look at. And the spectrum or the range is that's credit score. So anything that I would say 550 and below, it's poor, right? And there's been, whether, the late payments and whatnot. So anything below 550, it's poor. But we would say if you need to borrow money, you would fit into the private institution money, right? So typically the interest rate is higher and you're going to need more security. So it's not that you can't get a mortgage, right? But it's going to be very costly because private money is probably the most expensive money you can borrow from. And as you go up that range, let's go 550, 560. Now you're in, we call alt A or B lending. So the interest rate in this space is again more expensive, less expensive than the private, but it is more expensive than your prime. So, there's still some credit challenges. A lot of times in my B space, is clients who are currently in consumer proposal or they've just been discharged from consumer proposal. So there's been some kind of, I guess, you've worked with a trustee because it's been some challenges. And then I say 620 to 680 is what we call, it's good, right? It's good, satisfactory, it's good. That accesses prime money. So your institution that you see, they're your big banks, right? And your monolines, you can get a mortgage through them, but being just good, right? Or satisfactory, the rest of your application has to be strong, right? And so it's the overall file that we look at because it's not excellent. It's just satisfactory. And anything above 680 is when we say, hey, that's excellent credit, right? At that point, it's it's your A and then up. And then I threw out there like on my like a 900 credit score is kind of like the unicorn. It doesn't really get you, anything more than like at 680 and up, you got access to the same rates, right, through the prime institution. But then you get a lot of respect from your lender, underwriter, and brokers because we don't often see it, but definitely it's one of those things where we realize like, yeah, it's mentioned as a unicorn.
Okay. So, let's just say our credit score is not as high as we'd like to be at. What could people do to improve their credit score?
To improve credit scores. So I think to approach this is let me look at what drops your score and what you shouldn't be doing, right? So when essentially what hurts your score typically, because a large portion of the FICO score is based on making minimum payments on time, right? Making sure your minimum payment always gets paid, right? Also utilization percentage. So your limit, your balance compared to what the overall limit is. So an easy number is 50%. Don't carry a balance more than 50%. It's just at that point, it shows that you have credit, but you're not relying on credit. There's plenty of room in your limits, right? So it's when you start to push the upper echelon of like, let's say the 90% of the limit, your balance, and especially if you go over that limit, your balance is over limit. Not only when it reports, it's, that drops your score. And secondly, you're getting an over limit fee on your banking, right? So it's costly. So being over limit or even near limit, right? Utilization percentage, missing your minimum payment, always make that minimum payment at the very minimum, right? I guess do not close any credit cards or lines of credit. That history behind that card is very valuable. And I know a lot of, people say, I don't want to rely on credit. Well, your credit history is a huge component if you want to go and get a mortgage. You not having any credit history actually works against you. So you need to have some credit, right? So don't close any, and that just, if you're not, you just put it away, right?
Yeah.
Open it and just, if you're not relying on, if not using it, you don't want to rely on it, just put it away, don't close it.
Yeah, I wish I would have known that earlier because just over the last year, I've closed, I think, 3 or 4 of my credit cards or line of credits or what have you that I wasn't using, thinking, well, why do I want to keep these? I don't use them. And oops.
Oh, well, you know what? Like when I say, don't close them, I'm saying if you have at minimum, you should have two revolving credits at minimum. So it's a line of credit or credit card. So if you have that, that will be enough, and the limit at least 2,500 at each. Those two will be enough to help your credit score and the health of your credit report, right?
Hmm.
Whereas if you have less than that, let's say you close everything and you only have one or none, that's when it really hurts you, right? So keeping it open. If you have a lot, then I do suggest, you know what I mean? Have one for personal, have one for business. There's, some rewards cards, but I mean, you shouldn't, I don't know, like this is an opinion of mine, but you shouldn't have more than five. Do you know what I mean? Like accounts, right? So, I mean, as you get, there is such a thing as too much credit, right? So, it doesn't hurt you, but the fact that like I think it's lots to manage, you have more than five. I think it's just like more of a management thing as opposed to being the lenders looking at that and saying, hey, you know what, there's too much credit.
Okay. So what else can we do?
Oh, correct your Equifax report. So
Hmm?
um so the reporting agency isn't 100% accurate. It naturally it's going to have some mistakes because what happens is when you're applying for credit and someone's keying in your information, information could be incorrect, right? I've seen whether it's personal information is correct, but what's most important is there's sometimes what happens is if you pay out a loan, a vehicle loan or any kind of loan, sometimes it doesn't report back to Equifax. If the Equifax doesn't get notified that loan is no longer active,
Hmm.
right? The balance will still remain. There's still a balance showing. So it's a good idea to be proactive because if I'm at the mortgage process, right? So that's why I love doing a pre-approval, right? But let's say you end up, I don't know, you go in and you throw an offer and you full credit as you have a pending live deal. That loan that you paid out still shows a balance. You have to clear that off, right? And
Right.
sometimes if that balance is, a near limit or what I mean, that's going to negatively affect your score. That affects your score being on there. So you can get a hold of Equifax and pull up personal credit without it affecting your credit score, and then see if there's any errors, right, and anything you need to correct. So it's a good idea to do, but
Hmm.
oftentimes it's caught at the time when you have when clients are looking for a mortgage or maybe financing for a vehicle, right? So try to be proactive about that. And yeah, I guess apply for credit only if you need it, right? So again, like trying to not have too much credit when you know what I mean? Like if you have five, why do you need six, or more than that? It starts to be a little excessive, again, to manage.
Right. Well, one of the things that came to mind when you're mentioning, having paid out a loan and making sure that it gets removed from your bureau. Don't also forget that at least if you're leasing a vehicle, it's the same thing. If you pay out or buy out your lease, make sure, check and make sure that it gets removed. I don't know how long does it normally take for that to happen?
For it to be removed,
Yeah,
uh,
from the day you say you paid
Equifax
out.
could Equifax can turn around rather quickly. So I've had situations where it takes a few days, and
Hmm.
sometimes I think a couple of weeks, right? So there are avenues where I know with a mortgage broker or like those in the industry, if we're submitting I guess a request, it does get expedited. So I do, as a mortgage broker, know that I know that I can get a faster turnaround than if I send my clients to do it themselves. So
Right.
could be definitely a few days.
Yeah, but well, I know that a lot of the banks, when you do online banking, gives you access to your credit bureau. So what you may want to do is after you've maybe paid out a loan or a lease, a month later, go check if it's still there. And if it's still there, maybe try to follow up and find out why it's still there. And if it's definitely paid off, contact the credit bureau and have it corrected.
Yes, any payment of a big item, right? Anything installments, right? Keep receipts. Keep every single receipt. If you paid out a collection item, ask for a receipt. Keep it on file. I remember I did a video on Instagram, social media. Documents you should keep. You should always keep
Mm-hmm.
receipts of any collection items, anything you pay out. Keep those receipts because if the collection agency or that lender or financial institution doesn't go back to report to Equifax, it still remains there. Then you can take that receipt and you can go to Equifax directly and then get that those debts removed off your bureau, right? So never always ask for a receipt and always keep it on file. And same with
Okay.
same with if you've ever had a consumer proposal, a bankruptcy, those trust papers from the trustee and the discharge, you need to keep that paperwork because it's going to come up when you're trying to get financing for a mortgage.
Right. So you just brought up, consumer proposals and bankruptcies. Of course, from time to time, we run across people who've had financial struggles in the past and gone through a consumer proposal or bankruptcy, what do they need to do to put themselves in a better position to get a mortgage?
Okay, so again, it depends. It all depends. Brokers have access to the three levels of lending. You've got your prime, you got your B, and you got your private. So consumer proposal puts you typically in the B space, right? I'll take B space. So if I have clients who currently are in consumer proposal or actively in a consumer proposal or recently discharged, then I know that's, if they have 20% down, they're going to be, they can still buy, but the interest rate's just like a little higher, right?
Mhm.
But when I put them in that program, the plan is to always graduate to everyone to back to prime space, right? And so to qualify back at prime, lenders requirements, standard requirement is 2 years discharge with 2 years reestablished credit. And the reestablished credit, typically the ideal established credit is revolving credit. So lines of credit or credit cards. It's like you can pay down and you can readvance, right? That credit builds, your score the fastest. So typically, and we would want to see a minimum of $2,500 as a limit, because I know once when you typically when you finish a consumer proposal, there's no credit. You've got to rebuild credit, and a lot of times the new credit will start at $500, a very small limit, right? So that's why the lender would want to see how well you manage a larger limit, like, a larger limit. And the limit typically ideally starts at $2,500, right? So if you have two trade lines or credits, right, $2,500 each built for 2 years past discharge. And so it's very important to note it's 2 years after discharge. So I've had some clients that have carried credit cards or, loans through the consumer proposal. Those don't qualify. When I was talking to lenders, and lenders are very specific, it's got to be a new established credit after the date of discharge, because on my credit report, I can see when it was discharged, right? It shows discharge date. And so the new credit that's open, I can see when it's open, and that has to line up to be after the discharge.
Okay,
Qualify.
great. Well, Cheetah, I'd like to thank you for sharing your wealth of knowledge with us today. I think, um, is there anything else or any final comments you might have for people listening today?
For clients, having, I think we need to normalize the fact that, what, life it's going to throw challenges, and everyone's going to go through times of, financial difficulty. And so just understand your credit, your FICO score, right? It's a fluid number, like the score, it's fluid. And you know what? There is life after consumer proposal. There is life after bankruptcy. Do you know what I mean? So there is always time for redemption, and never think just because you're in that space that you'll always remain that space. So when I'm working with clients who are rebuilding credit, right, it's like the goal is to always graduate them to the prime space, right? So again, it's not the end of the world. And I feel like in the last 5 years, the entire globe, right, we're on lockdown. There was financial challenges are the norm, right? And then we had that inflation shortly afterwards. So it is, we can normalize and not be shameful that there are, people who typically have always been prime, prime clients, and they've always had, great credit. And in the 5 years, it's like it took a blemish, and naturally, because of what we all had to go through, right? So, but it doesn't mean they need to stay there. And and as long as you're working with a mortgage broker, can set you on a plan to get back to where you used to be.
Right. Okay. Well, again, Cheetah, thank you very much. And for today, I want to wish everybody a great day. But don't forget to like, comment, and subscribe to our channel for more of these incredible videos where you learn more about your mortgage and your home. For now,
Thank
take
you.
care. Bye-bye.
Bye.